What a week, except for Monday, in which we had a bearish intraday reversal. That's where you open up, trade up with the highs of the day, and then roll over and close on the lows of the day. We had that on Monday, and then the rest of the week ripped higher, starting at 10,200 in the Dow, and if we close right here, we're right about 10,450, give or take a point. It's options expiration week, and it looks like the one big downdraft was on Monday. It'll be interesting to see where we close at. We've shrugged off a huge amount of bad news to close up on the week, if we do in fact close around where we are right now. It's very bullish for stocks to digest bad news like this in stride. We're seeing people want to get ahead of earnings season, so they can certainly understand that thesis. It's basically the one that we hold here. In order to be comfortable staying long, though, we're buying puts as the VIX comes in. Today the VIX was down again, and we want to encourage you to buy protection, now available at half off what you would have paid just 2 weeks ago, when volatility was near 40 in the VIX. We're under 24 now in the VIX, and you need some kind of hedge as we work higher, because we have been in a trading range so far this year. You need to make sure that as we approach the top of the range, that you're protected so that you don't get your face ripped off if we lose 400 Dow points or more and trade back down to the bottom of the range. For those of you who are technical traders, investors, please be aware that there is tremendous concern for the S&P up near 1130 to 1150. If you look at a 6-month chart of the S&P, you can imagine a head and shoulders with the left shoulder a high of 1138, which we hit 3 times before rolling over and starting the neckline on February 8th at 1056, with the head reached 1217 on April 23rd and then completing the neckline on June 7th at 1050. That's why the 1130 to 1150 level is a big concern. Please, please, please either sell something at that level, buy puts, or at a minimum, get long the VXX as a hedge. It's okay to lose money on your hedge. Remember, your hedge is just a portion of your portfolio, say up to 10%. In fact, if you're long with 90% of your portfolio, you want your hedge to lose money so that your portfolio continues to grow. It's wrong, very wrong to think that everything you own will make money. That's not how a diversified portfolio works. It's that you have something working all the time and then manage accordingly. That's why we told you to take off the VXX position when the VXX hit 34 on May 20th. It's gone straight down since we told you to take it off, with only a momentary spike June 7th. It is worth it to manage your hedge positions, taking them off and putting them on when appropriate. We're staring pretty intently at our positions today, and it's options expiration, and we do not want to be caught off guard by anything in the last hour of trading. Please, if you're short cheap options, take them off and move on with life. Don't run the risk of turning a winner into a loser by being cheap and not wanting to pay the commission. Be disciplined. Hope you caught our man on the street, Brad, on the top of the show last night with Jim Cramer on Mad Money. We put together a nice photograph for Jim Cramer, and Brad was able to present it to him near the top of the show. Even though he drove all night long to be back for OPEX, he's manning our trading desk today to make sure nothing takes us by surprise. I have to point out that being long STD and BBVA has been a monster trade for us. Please, if you're a trader, just take your toys and go play somewhere else. For those of you who are investors, these stocks pay very good dividends. We do think the stress tests show that they are better off than people think. How are we playing it? We're long, and we're long puts against our position. We're not going to look a gift horse in the mouth, and puts on STD in particular are very cheap right now, especially compared to 2 weeks ago. So please be aware that the reason we can be so confident is because we're playing with a net. If you're not, be concerned. Always be concerned about what can lose you money. One more name before we leave you for the weekend. Deutsche Bank, highlighted by Jim Cramer this week as a way to play financial regulatory reform having a huge fight, is a name we continue to like. The stock is in the red today. It trades with a PE of 6.17 with a forward PE of right around the same. The peg is only 1.17 with a 1.29 trillion in cash and only 432 in debt. They have something like $2,086 per share in cash on a float of $585 million in stock. The book value of this bank is $77.75, and the stock trades at $62. You really need to take a look at Deutsche Bank, symbol DB. If you can't bring yourself to be in just DB, strongly consider the iShares Germany ETF, symbol EWG. This will give you access to Allianz, BASF, Bayer, Daimler, Deutsche Bank, Deutsche Telekom, which we also like, SAP, Siemens, and more. German companies will benefit tremendously with a lower euro. This must be kept in focus as the ECB has already said that they're comfortable with the decline in the euro and it's part of the strategy. The US would never admit that during our dark days, even though we know full well the US was happy with a weak dollar as it bolsters the currency translation profits for our biggest exporters. Okay, enough economics class. That should give you all kinds of things to think about over the weekend. Buy something German. Deutsche Bank or Deutsche Telekom is a great way to do it, and you can own a good chunk of the market via EWG. Thanks so much for tuning in again. Next week will be very exciting with Brad at the Invest Like a Monster conference in Chicago, Friday and Saturday. Their next guest on AFT will be announced June 28th after the interview is in the books. Have a great weekend, and we'll see you on Monday.